Welcome to the Wealthwise show, where financial wisdom meets the road to prosperity. Get ready to embark on a journey to make wise financial decisions and unlock the secrets to building lasting wealth. I'm your host, the Wise Investor, and just as a disclaimer, go get some compliance out the way. This podcast is intended for educational purposes only. It is not intended to be tailored personal advice, because I don't give personal advice on the internet. So keep that in mind as you continue to listen to this podcast. That is for educational purposes only. And if you hear a product, like a service or a company, anything like that, I'm not endorsing them unless they're sponsoring the show. Well, then it's an endorsement. So just keep that in mind as you get into today's episode of the Wealthwise Show. Alrighty, guys, time for another wonderful episode, and this episode is a milestone episode 20. We did it, guys. 20 weeks. It feels the same. So I appreciate you guys working with me for 20 whole weeks, listening to me for 20 whole episode. And I don't think it's been 20 weeks. I think some weeks early on I did like multiple episodes in a week, but 20 weeks sounds better. So I appreciate you guys rocking with me, listening, tuning in week after week. I appreciate it. Housekeeping, guys, educational purposes only. Anything I say is for educational purposes only. It's not meant to be taken as personal, tailored advice, because I don't do that on the internet. And I don't know how many times I have to keep saying that, but I guess I have to keep saying it every episode because I'm told to say it every episode. So please take everything I say with the viewpoint of using it as education and learning and making wise decisions, and not as personal advice, not as me telling you what to go buy, what to sell, what company use, all that good stuff. You know, we're all adults, so these are decisions you are going to have to make on your own. So with that said, today's episode is going to be a good one of my favorite things. So a little bit about me. I am a day trader as well. Day trading is my night job, I guess. I don't do it at night, but as they say, your day job. So being an advisor is my day job, but I do trade. I trade commodities, future commodities actually, and I trade index futures. And that's what today's episode is about. Commodities. Whoa. Yes, commodities. One of my favorite things because they're easy. They're easy. Not a lot of work, not a lot of, very simple. Back in the olden days, this is how things were traded. You had pork bellies, you had cattle, you had wheat, you have orange shoes, you had oil, you had gold, silver, and all you had to do was just say, hey, I want that at this price. All right, I'll sell it to you at that price later on. And that was it. Beautiful. So let's talk about commodities and what they are and how you can invest in them without being a futures trader. So let's get into this. Alrighty, so commodities. I don't think I've talked about commodities on this show before. But like I said, there are, back in the day before the New York Stock Exchange, before the current things we have now, people used to sell commodities, gold and silver and copper and wheat and corn and all that stuff. So those are considered commodities. And when you're trading futures, they're contracts. So I know people associate contracts with options, the option contracts. Well, the futures contracts came out before the option contracts. So these are the OGs, but future commodities contracts our future contracts is basically very, very simple. It's a contract that says you want to buy a certain thing at a certain price on a certain day, usually at expiration. Kind of similar to future or options, but the difference is you don't have that extra like theta, delta, gamma, all of them things. You don't have to worry about all that stuff when you're dealing with futures. It's a very simple, hey, this is what it is, this is what I want, and there you go. And the reason why people will use a future contract, if you're a producer or a buyer from a producer, like let's say oil or things like that, the prices fluctuate. So you want to lock in a price to buy, like let's say price for oil is low and you're buying from a producer and you're like, hey, price of oil is low. I'm going to lock in this price here. And then when the contract expires, you take delivery. And if you're a producer, it's very similar. Hey, I know the prices are going to go down. And so when I sell this stuff, I know it's going to be, expensive, or it's going to cost me a lot to sell because I'm going to be losing a lot of money. So I'm going to sell this contract here. And when the price go down, it hedged my, business. So hopefully that makes sense. Sorry, I'm not under the weather. I'm just having some allergies. So hopefully that makes sense. And so when you are, looking at commodities, there are a ton of different things in the commodity market. And what I mean by things, I mean commodities. So you got your gold, I know I said like 18 times. You got your gold, your silver, your copper, your wheat, your corn, your pork bellies. I just like saying pork bellies. Your pork bellies, your cattle, just commodities essentially. Usually farmers and miners and things like that. And you got index futures as well because those are considered commodities. So let's talk about some of the ways you can invest in those things. So because commodities now, the futures market, the commodities market is so different from before. You can't just invest in them. Like I can't go up and get a broker and be like, hey, broker, I want you to buy me X amount of contracts on this commodity. Now, some brokers do offer that, but a lot of brokers don't offer that. And the ones that do are going to require you to prove or go through some forms to say you know what you're doing, because the commodities market can be very difficult to navigate if you're not a professional. But there are ways you can still invest in it without having to deal with the headache of, watching the news, watching reports, worrying about this or worrying about that. Now, if you're going to invest in commodities, you're still going to have to worry about those things, but you are insulated if you are using a fund, ETF. And what I mean by insulated, not insulated from risk, but you don't have the tremendous downside of actually owning the commodity. Because let me tell you, if I lost 2% on one share of an index ETF, and I lost 2% of one contract of the S&P 500 ES futures contract, those 2% are completely different. Completely different. One share in one contract of similar investment vehicles are, investment vehicles, that is different. Like I can lose way more, that 2% on, actually, I'll do some math for you. So let's do some math really quick. So one contract on the ES, it pays you about $12.50. All right. So let's say the market is at, let's use round number 4,200. We take away 2% of 4,200. That's 81 points. So 81 points, or not 81, 84 points. So 84 points in tick form is going to be 336 ticks. And the reason I say go by ticks because they don't go by, each tick. Think of it as like a quarter. Think of 1 point as $1, and you divide it up by 4. And each fourth is considered a tick. So you can say 25 cents is a tick because that's how they have it. So you're looking at 336 ticks are 84 points times 12.50. That's $12.50. You're looking at $4,200 that you just lost. 2% in one contract. All right, let's take that same concept. You got $420 on the index ETF, and you take away 2%. That's $8.04. So one share of that index is going to be, or one share of that ETF that is tracking that index is going to be $8.40. See how drastically different that is? So that is why when I say, owning the ETF can insulate you is because of. So when I say insulate, I don't mean like you're not going to have no risk. It just means you're not going to, have a heart attack when we have a 2% drawdown for the day. So investing in the commodity ETFs or mutual funds can help you participate in the commodity market without risking your shirt. So yes, everyone will want to own gold, but trust me, you don't want to take physical ownership of a gold contract. So that's another highlight of, owning the ETF because you're not on the hook for the ownership of the contract. But the thing is, I'm not gonna lie to you guys, you're not going to get ownership of the contract. I don't think there's no future broker that will allow a retail trader to take ownership of, or take delivery of that contract underlying asset. But you don't have to worry about that at all if you own the ETF. So some of the ways that you can invest in, like I said, in the commodities is buying the ETFs, the mutual funds of said commodity. You can buy oil ETFs, you can buy index futures, the index ETFs. You can do gold, silver ETFs. And the thing that, I like about commodities, and I'm not just talking about, trading the future contracts. I'm talking about investing in the commodities because it can be a hedge at times. It can be an inflation hedge. It can be produce diversification and things like that. The returns are not bad. So understanding that, commodities can provide a hedge in diversification, you may want to talk to your financial advisor about and see if it is the right fit for you. But there are some downsides to also owning commodities. Like I said before, 2%. 2% is a lot. So yes, commodities can go down to the ground or go to the moon. So commodities can very well be very, very volatile. If you pull up the futures contract for gold and see how it moves, yeah, it can look like a meme stock. I personally have seen gold drop so many points. I don't want to say a number because I don't actually remember the number. I just remember seeing a large daily candle that was scary. And then it recovered. So it can be very, very volatile. It can have a lot of risk to it. So it's not something you want to just throw all your eggs in one basket. But it is something that you may want to look into if you're a financial advisor or if you feel like it's the right fit for you. So like I said, you can have the ETF, as long as your broker allow you to buy ETFs, you can have any commodity ETF in your brokerage account, in your what you call it, and they do have fees attached to it. Understand that, because it is ETF expenses, and because you are investing in commodities, some ETFs and some mutual funds might be a little more pricier than others. So that's why understanding and reading the prospectus and understanding the expense ratio is important. And commodities to me is a alternative investment strategy. So it's not your traditional, like, investing in a company or anything like that. You're investing in a commodity, something that is needed. So unless, the earth start producing, moving away from the mic, unless the earth start producing oil, there's always going to be oil there. So you don't have to worry about commodities going out of business. And that's going to be good, because when, there are some turmoil in like the equity sector of certain companies and things like that, it can be, like I said before, it can be a hedge. So there are different ways you can mix and match. And some of the popular commodities are going to be gold, silver, like the precious metals, oil, natural gas, agriculture, and things like that. So, if you are an oil person, you oil commodities and things like that. Now, the next thing I'm going to talk about is leverage commodities. And the reason I'm going to talk about it is because why not? But it is not something for everybody. So this is something that not everyone should look into, because it is very volatile, and volatility can be very scary for people, and they might think that they're ready for the volatility, but they're not. There was an analogy that I went to a advisor training for my firm, and there's an analogy that one of the senior advisors there mentioned about volatility. I live in Florida, so we go on boats and go to the beaches all the time. And if you, the person I'm talking to, if you are sitting there and I say, hey, I invite you on a yacht. And I'm like, hey guys, I got this yacht. It's not really a yacht. It's really more of just a boat, but we're going to call it a yacht because why not? And it's going to be great. We're going to go out there to the Pacific, and we're going to go fishing and all that good stuff. And you say, yeah, man, that sounds great. And then day of, we get out there on the beach. We're looking out on the shore, looking at the water, and say, oh man, what a beautiful sunrise. And I say, hey man, I heard that it's going to be a little choppy today. Are you still cool with going out there on the boat? And you say, yeah, man. And we look over the horizon, and it's like, it looks nice. You see the waves, and you hear the noise, you hear the birds chirping, you feel the wind. And it's like, oh, yeah, I think I can handle that, guy. I'm like, all right. Just let you know, it's going to be choppy. Just keep that in mind. And you say, yeah, I can handle that. And then we get on the boat. We go out to sea. We can't see the shore no more. And it's 10, 15-foot swells. I mean, we're going up, down, non-stop. The boat is literally just moving side to side, front to back, and you get seasick. And you come to me and say, hey, man, you didn't tell me it was going to be like this. I'm like, yes, I did. I said it's going to be choppy out there. So the point of that analogy is what you might think you can endure might not be what you can actually endure. So I'm going to talk about leverage commodity ETFs, but it's not for everybody. So the point of leverage commodity ETFs pretty much allow investors to take a short-term bullish or bearish position on said commodity using shares of a fund. So, quite famously, there are some index ETFs that, you you can use leverage ETFs on, let's say, it's short term now. It's not long term strategies. Anyone will tell you it's long term strategies. Eyebrow raise. Yeah, I smell what you're cooking. And it's a scam. But it's short term. And if you feel like, hey, we're about to get to a market downturn, and I want to hedge my portfolio. So you can buy said leverage ETF for bearish. So they usually have an S, for short. It'd be S, whatever the fund name is, or, L, whatever the fund name is for long. And, depending on like your position, like if you are long, of course you're going to be long because you're a long-term investor. If you're long and you have all these shares in this ETF, like, let's say the S&P 500 ETF, and you want to hedge, one of the easy and quickest way you can hedge is just buy the inverse ETF, which is considered going to be a leverage ETF. And the reason why I leverage because the ETF fund is more likely using future contracts for it. So like I said, that 1% or that 2% on the futures contract can be heavy. Well, if you're using a leverage ETF, you're going to feel that heaviness. So that's why, I don't think it's for everybody, but it can be beneficial for people who are on top of their portfolio. So if you don't have a money manager to kind of help you hedge and you're doing it yourself, if you're more active, more hands-on, do-it-yourselfer, then, an inverse leverage ETF can be something to help hedge. They're usually really cheap because they're not meant to be held long-term. And you usually can get in and out of them, especially if it's ETF. But, these ETFs do aim to provide multiple returns. So if, let's say, the regular ETF, index ETF produces 2%, and say that 2% is $20, then the leverage ETF is probably going to produce 6%. And that's going to be $80. So keep that in mind. And that sounds nice, but keep that in mind. The opposite can definitely happen as well. So leverage ETFs are a good way to hedge using commodities. So pretty much sums up the benefits of commodities. I really like them. I think they have their place and they're very useful in a lot of situations, especially when it comes to hedging. So it's really more of a hedge situation than an investment situation. So understand that there are significant risks to investing in commodities, and it's something that you really should talk to a professional about before you think about doing, because I don't want no one getting hurt out there. So even though you can be highly diverse putting those in your portfolio and the returns can be significant, please evaluate the risks, understand that your risk tolerance might not be what you think it is, and talk to a professional before you do it. So guys, that's been another great episode 20. It's been a pleasure. 20 weeks or 20 episodes in. Hopefully, you guys took some wisdom from any of this stuff I've been mentioning. And yeah, that's pretty much it. Nothing special, really. Wait until I get to my 100th episode. I don't know what I'm going to do for my 100th episode, but it's going to be something. So, guys, that's going to be it. I appreciate listening. Please like, comment, subscribe, whatever you do for yourselves when you're listening to my podcast. As long as it's positive, do it. So I appreciate it. Talk to you guys later. And so until next time, stay Wealthwise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the Wealthwise Show. The Wealthwise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.